$880 billion. This astronomical sum is what the U.S. government pays annually in interest alone on its national debt. That's more than the entire defense budget, more than spending on healthcare, and this number keeps rising every single year. Welcome to the biggest debt trap in financial history. While governments worldwide drive their debt to record levels, capital markets increasingly decide the fate of entire nations. What began as an economic policy tool is evolving into an existential threat to the global financial system. The showdown between states and bond markets is inevitable. Chapter 1. The Anatomy of a Debt Crisis. The numbers are unambiguously alarming. The average debt-to-GDP ratio of developed economies today stands at 100%. That's exactly the level of 1945, the end of World War II. The crucial difference: back then, there was war. Today, we're officially in peacetime. The United States runs a budget deficit of 7% of GDP at full employment. Japan struggles with debt exceeding 260% of GDP. Italy, France, Canada, the same picture everywhere. Projections for the U.S. show an increase to 160% debt to GDP within the next 10 years. This trajectory is mathematically unsustainable. The mechanism behind it follows fatal logic. Rising debt requires higher interest payments. These interest payments consume other expenditures. To pay the interest, governments take on new debt. The spiral accelerates with each cycle. Government bonds are the backbone of modern financial systems. When a government needs money, it issues bonds, essentially IOUs with fixed maturity and interest rate. Investors buy these bonds and receive regular interest payments called coupons. The critical indicator is the yield. When a bond's price falls, its yield automatically rises. And this is where it becomes critical for governments. Rising yields mean exploding credit costs for the entire state. The bond market functions on supply and demand. As long as investors view government bonds as safe investments, demand remains stable and yields stay low. However, if confidence collapses, a sell-off begins. Prices crash, yields skyrocket. At this moment, a government loses control over its financing costs. Government bonds traditionally represented the safest part of any portfolio, but this certainty is crumbling. In times of rising inflation, bonds become toxic assets. Guaranteed interest payments lose real value while default risk grows. 25% of all U.S. government revenues now flow into debt service. That's the classical definition of a debt trap. The government can neither save its way out nor inflate its way out. For every percentage point interest rates rise, debt service costs explode exponentially. This creates a vicious cycle that repeats faster each time until something breaks. Chapter 2. The Power of Bond Vigilantes. In 1983, economist Ed Yardeni coined the term bond vigilantes, bondholders who enforce fiscal discipline through their market behavior. In the 1970s, bond investors suffered massive losses from galloping inflation. Yardeni argued these investors would henceforth force governments into line through selling pressure. The concept is simple and brutally effective. When investors deem a government fiscally irresponsible, they sell its bonds en masse. Yields explode, credit costs surge astronomically. The government faces a choice: drastic austerity measures or financial implosion. The most spectacular case occurred in 2022 in the United Kingdom. Prime Minister Liz Truss announced a debt-financed tax cut program without considering the markets. The reaction was devastating. Within days, British government bonds collapsed. Yields shot through the roof. Mortgage rates practically doubled overnight. The Bank of England had to intervene with emergency purchases to prevent complete meltdown. After just 49 days, Truss resigned, destroyed by the capital markets. This incident sent a clear message to all governments. Bond vigilantes are real and they are powerful. One wrong move can bring down a government within weeks. When vigilantes attack, the sequence is predictable and brutal. First comes the quiet exit. Sophisticated investors start reducing positions. Then the rush for the exits begins. Pension funds, insurance companies, sovereign wealth funds, all selling simultaneously. Liquidity evaporates. Market makers step back. Within 72 hours, a seemingly stable situation transforms into a full-blown crisis. Bond vigilantes respond to specific triggers. Unsustainable fiscal trajectories. Political chaos undermining credibility. Monetary policy conflicts with fiscal policy. But timing is unpredictable. Markets can tolerate dysfunction for years before suddenly losing patience. This unpredictability makes vigilantes terrifying. Governments cannot see the attack coming until it's already underway. Chapter 3. The Great Powers Dilemma. The United States occupies a unique position. The dollar is the world's reserve currency. U.S. Treasury bonds serve as the ultimate safe haven. Central banks and investors worldwide must hold dollars, so they buy U.S. government bonds. This privilege allowed the U.S. decades of deficit spending without serious consequences. But even here, fundamentals are changing dramatically. The deficit stands at 7.5% of GDP. At current interest rates, this leads to exponential growth in interest burdens. The Trump administration announced a Department of Government Efficiency under Elon Musk, supposedly to save $2 trillion. Even Musk walked back this number. The reality: structural savings of this magnitude are politically impossible. Simultaneously, the administration plans massive tax cuts that will further balloon the deficit. The bond market watches this development with growing nervousness. So far, confidence in the U.S. holds. But the question isn't if, but when bond vigilantes will move against America too. Reserve currency status is both blessing and curse. It enables deficit spending at lower rates than any other nation could achieve. But this creates complacency. Politicians assume markets will always absorb more debt because they have no choice. This assumption is dangerous. Reserve currencies can lose their status. The transition happens suddenly in a crisis. The dollar's dominance makes the eventual adjustment more catastrophic, not less. Japan demonstrates an alternative path. With over 260% debt to GDP, the country should have collapsed long ago. Instead, the economy continues functioning, albeit with minimal growth rates. The critical difference: Japanese government debt is almost entirely held domestically. The Bank of Japan systematically buys government bonds, keeps interest rates artificially low, and prevents any market pressure. This approach only works under specific conditions. Japan has high savings rates, closed capital markets, and extreme social cohesion. The yen lost 70% against the dollar, a hidden tax on all savers. For Western economies, the Japanese model offers no blueprint. Moreover, Japan shows the price. Economic stagnation is the cost of seemingly endless borrowing capacity. The Eurozone presents a special paradox: common currency without common fiscal policy. Germany represented iron fiscal discipline for decades, while Italy and France accumulated debts. Germany's new chancellor just announced a dramatic reversal: hundreds of billions for defense and infrastructure, financed through the new debt. Germany's entry into the global debt party comes precisely when the party is ending. Italy navigates cautiously under Prime Minister Meloni. EU funds are tied to fiscal conditionality. Bond vigilantes watch Italy less critically than France, where political chaos prevents consolidation. The Eurozone demonstrates that without central fiscal authority, the currency union remains vulnerable. A bond sell-off in Italy would send contagion effects cascading through the entire region. Chapter 4. The Inevitable Crash. All factors point towards systemic rupture. The debt burden is historically unprecedented. Interest rates are rising structurally. Political willingness for consolidation doesn't exist. Demographic change, defense spending, climate change, every trend requires more expenditure. The trigger is unknown but inevitable. Perhaps a conflict between the U.S. government and the Federal Reserve. Possibly a new inflation wave, or simply the point where investors collectively decide the risk-return profile of government bonds no longer makes sense. The crash will unfold explosively. Bond prices collapse within days. Yields spike to 10, 15, 20%. Refinancing becomes impossible. Governments face a choice: drastic emergency measures or default. Two scenarios are realistic. The first is hyperinflation through monetary financing. Central banks buy all government bonds, print money without limit. The currency collapses, savings are destroyed. This path has been tried throughout history. Weimar Germany, Zimbabwe, Venezuela. The script never changes. Once inflation expectations become unanchored, the spiral becomes self-reinforcing. The endgame is currency collapse. Capital flees. Supply chains break. The economy degenerates into barter. The second scenario is financial repression. Governments force pension funds, banks, and insurance companies to buy government bonds at artificially low rates. Capital controls prevent escape. Yields remain below inflation, a hidden wealth transfer from savers to the state. This approach is more subtle than hyperinflation, but equally destructive. Savers earn negative real returns. Capital misallocation becomes endemic. Productive investment disappears. Financial repression requires increasingly authoritarian measures. Capital controls expand. Privacy erodes. Citizens become trapped in a system designed to confiscate their wealth gradually. The crisis will not respect borders. When one major economy's bonds crash, contagion spreads instantly. Investors flee all sovereign debt. Risk premiums explode everywhere. Emerging markets default first. Then the dominoes fall upward. Smaller European nations lose market access. Japan's bond market implodes. Eventually, even U.S. Treasuries face a buyer's strike. The financial system freezes. Banks hold massive quantities of government bonds, their balance sheets instantly insolvent. Depositors rush to withdraw funds. Governments impose bank holidays and capital controls. Within weeks, the global economy grinds to a halt. Trade finance disappears. Supply chains collapse. The veneer of civilization proves very thin indeed. What emerges from the ruins is unpredictable. Historically, debt crises of this magnitude precede major regime changes. Wars, revolutions, the collapse of international orders. At minimum, expect massive wealth destruction. The global middle class will be impoverished. Retirement savings will be wiped out. Social mobility will reverse. The debt question isn't whether, but when and how severe. The system is based on the fiction of unlimited creditworthiness. This fiction ends the moment markets stop believing. The greatest financial bubble in history is not the stock market or real estate. It's government bonds. Trillions in supposedly safe assets based on the assumption that governments can never become insolvent. This assumption is false. And when markets realize it, the collapse will surpass anything seen before,